And you've been calling, Greg, for this decline in yields, or at least a stasis where we are, despite some of the inflated expectations earlier in the year for inflation. Here we are at a precipice where bulls on Wall Street cannot get bullish enough about equities, where bond veterans are looking at the bond yields here and saying they're not going to move that much. Do you think that people could be surprised by bond yields going lower being a bear case for equities?
Yeah, I think that's a distinct possibility. It's not my base case by any stretch. I actually think we're in this symbiotic relationship where low yields really allow equities to outperform, right? It's not only the discounting mechanism that's much lower, so pushing up valuations, but it's just a low, stable yield environment is just broadly supportive of growth, broadly supportive of earnings, and should be broadly supportive of risk assets. So I actually see the two actually pretty much aligned here. But I think your question ultimately is if the bond market really starts to sense and suss out a rolling over of economic activity, then that's clearly not a great outlook for stocks.
If Jay Powell this Friday at his speech at the virtual Jackson Hole Symposium comes out and forecasts or foretells an earlier taper than the market is expecting, says November rather than December, as most people seem to expect, what's the reaction in markets?
I don't know. I mean, personally, I don't think a month matters. I mean, if the markets are that sensitive around November versus December, then I just think it's kind of looking for an excuse to take some chips off the table. So I'm not overly worried about it. That's my personal expectation that the Fed starts to taper in November, maybe December. But either way, they're tapering. And then equally, I'm not as jammed up over a taper as some other folks, just given the fact that you're seeing this massive shrinking in Treasury supply at the same time.
Greg, part of the stresses that are out there now is historic liquidity. Every morning I look at overnight repo. We've now gone out over $1 trillion. We're grinding higher. I've got experts telling me it's no big deal. But how does the wall of money that's out there fold into the PGIM yield? How does it fold into the simple idea that we want to observe and guess where yield is going?
Yeah, I think the technical dynamics are important here. Typically, I don't think it changes the direction, but I think it exacerbates the move. And so that's why I'm focused on Treasury supply going forward, as I think the fact that you're going to see a decline in Treasury supply next year and several years after, I think is highly supportive. At the same time, the U.S. is winning by not losing, right? So the fact that you're seeing so much foreign investment into the U.S.,
Right,
into the bond market is also supportive. So I think these are really supportive factors, but ultimately it does point to the fundamental piece. And so I think fundamentals are the driver. I think the technicals just exacerbate it.
I don't want you to make a sell-side bracketed 10-year call, but I do. As a guy running institutional money, with that belief on liquidity and on Treasury supply, bracket the 10-year yield as you see it now, a year out or 2 years out.
Yeah, so I think our level, 2 years forward is about 80 basis points on the 10-year. Our call for the end of this year was 120 basis points. So we're in striking distance.
Yeah, that's
that felt
wonderful.
Like a terrible call in the first quarter, Tom. I have to be honest with you.
You
It
aged.
was quite painful. Yeah, I did. But I think longer term, we see an environment where yields will remain low. And honestly, I struggle with the narrative that yields are going to jump post-Fed taper, post-economic activity that's off the charts, peak inflation, all those sorts of things are in the rear view. And to me, I just don't really see in an environment where yields, after all that's been thrown at the market, that yields will move higher after the fact. If it doesn't happen during, then I'd be shocked to see it happen after the fact.
I know that in about 4.5 hours' time or so, Tom Keene is going to be awakening from his nap, eagerly watching the 2-year Treasury auction we're getting at 1 p.m. Eastern time. He cannot wait. Neither can Lisa. When it comes to these auctions and the supply and who is buying, how do you think about foreign buyers in the Treasury market?
Yeah, I think it's important. I mean, we've been seeing it, particularly as we get closer to taper, whether it's November or December or January, who knows? The fact that you're seeing foreign buyers increase their purchase power within the U.S. Treasury market is important. Right. So I do think that's a strong technical factor. So I expect that to continue. But I try not to get overly taxed by a single auction event. But I think over time, though, you'll continue to see the auctions do quite well. Foreign participation to be quite high, and auctions to go quite well.
And of course, the U.S. in many ways is attractive because it's still the highest yield you can get in basically sovereign bond markets globally. And even if you expect yields to be staying lower when it comes to Treasury yields, is that still going to remain true?
Yeah, I think so. It's a relative game. We play a relative game. So we're looking at where yields are in Europe. We look at where yields are in Japan. And the U.S. By far has the most attractive yield environment. So I don't see that changing anytime soon. I don't think anyone is forecasting European yields to move above zero anywhere over the near term or ever. I really think the support for U.S. Treasuries, U.S. assets, period, will continue to be quite strong, which is why I think the dollar will continue to do quite well here. Which is somewhat against consensus, or was against consensus.
Greg, before we let you go, I want to ask a philosophical question. As we talk about the Fed and their ongoing $120 billion of asset purchases every month at a time of rising inequality, at a time of inflated asset prices, at a time when a lot of people are saying that corporate profits are as good as they're ever going to get and will continue to accelerate from here because of their dominance over specific sectors. Is this bond purchasing program more helpful than it is harmful at this point?
That's a great question. Clearly, inequality is something that has worsened, is worsened during the pandemic, post-pandemic, right? You're creating the wealth effect. Central bank policy is a blunt instrument. This whole portfolio channel effect, whereby raising asset prices to increase kind of spending at all to trickle down, hasn't really worked that well. So I think the Fed's focus will continue to be around getting real wages higher. So for me, the focus is less on asset prices, but getting real wages higher. And I think that's the most important piece of the puzzle here to solve, not only in the U.S., but globally, as inequality has really worsened quite dramatically here over the past 12 to 18 months.